Okay, let's unpack this. We're diving into the Volkswagen Group.
Oh,
I mean, a truly massive global automotive giant. And they are right in the middle of this monumental pivot to electric mobility. You've shared a really rich stack of sources with us: financial reports, sales data, some critical tech announcements. And honestly, the data tells a conflicting story.
it really does. And I think our mission today is to try and reconcile those contradictions
Yeah.
because you have a company that's hitting these huge EV volume milestones, which is proof,
No.
that the strategy is physically working. But at the same time, they're facing this incredible financial stress.
Right.
It's coming from strategic costs. It's coming from external geopolitical pressure. It's probably the highest risk scenario you can imagine for a legacy automaker.
And that high volume side of the story is, on its own, really impressive. The VW Group delivered just shy of 1 million electric vehicles worldwide in 2025. The exact number was 983,100 battery electric vehicles,
Right.
BEVs.
That is a colossal step forward. It's a 32% year-on-year increase over 2024. And what's really important about that 32% growth is that it pushed their overall BEV share of the entire group's deliveries to 10.9%.
They cracked the double-digit mark.
They finally did. And that shows a clear return to a really strong growth path after, EV sales sort of cooled off globally back in 2024.
That's momentum you just can't argue with. But here's the core conflict, the headline that just stops you in your tracks. How does the VW Group pull off 32% growth in EV volume while the operating result for the first 9 months of 2025 drops by nearly 58%?
Yeah.
It's a staggering financial contraction. You have this phenomenal success on one hand and this steep cost on the other.
And that is the central problem they're grappling with. That 58% drop is basically the consequence of massive, deep strategic investments. We're talking specifically about battery technology. That's their bid for future independence. But it's also coupled with these painful, non-recurring charges, things like internal restructuring and, of course, external trade tariffs.
So the volume isn't profitable.
Yeah.
Not yet, no. And they are spending heavily to make sure it will be. They're betting the entire company's stability on controlling their own core technologies.
So let's break down that 2025 scorecard first, that 983,100 number. But when we look closer, the momentum is, well, it's geographically uneven. Where is all this growth actually coming from?
It's primarily Europe. I mean, Europe is the unchallenged growth engine for the VW Group right now. BEV deliveries there surged by a massive 66% in 2025. They're still at the top of the market in Europe for both conventional cars and EVs.
And the future looks strong there, too. The order intake for BEVs in Western Europe specifically, that jumped by 64% in the first 9 months. It's accounting for about 22% of their total order flow. So Europe is definitely buying what they're selling.
Absolutely. Europe is essentially papering over the cracks, mitigating weaker performance elsewhere. And here's where we need to introduce a bit of nuance for you, the listener. The performance of the core Volkswagen brand itself is actually quite different from the overall group. Well, while the whole group surged by that 32%, the flagship VW brand delivered 382,000 EVs, which was a slight year-on-year decrease.
A 0.2%.
A decrease. Wow. That's highly telling. It suggests the group's success is being heavily driven by the higher margin or maybe the more specialized brands. You're thinking Audi, Skoda, Cupra.
Right. While the mass market Volkswagen ID lineup is facing tougher headwinds. Or maybe it's even a deliberate slowdown.
What are the strategic implications of that, the core brand flatlining?
It implies they're managing the rollout. They're prioritizing where they can command better prices and manage the complexity. Audi and Porsche are key to bridging that financial gap, but it also exposes just how fierce the competition is in the mass market. And those headwinds, they just get magnified in their other two major global markets.
Right, China and North America. The numbers there are
Yeah.
pretty stark. Oh, they are. Total group sales declined by 8% in China and a really punishing 10.4% in North America. And the VW brand, specifically in North America, saw an 8.2% drop. They pointed directly to U.S. tariffs and reduced subsidies for that.
And China.
In China, it's the intense competitive situation.
Yeah.
The local brands are just dominant, and that's heavily impacting their business.
So it feels like they're fighting a war on multiple fronts. They're trying to transform internally while getting hammered by external trade issues and local competition in their two biggest non-European markets.
That's exactly the situation. And just to give you some perspective on that nearly 1 million delivery number, let's put it up against their key global rivals in 2025.
Okay, so where does VW actually land on the global leaderboard?
They landed solidly in the number 3 spot globally, which is significant. BYD, of course, is still the dominant force. They delivered 2.25 million passenger BEVs.
Wow.
Second spot is held by Tesla, but here's a really important detail. Tesla actually saw its global deliveries drop by 8.6% down to 1.63 million.
So even the market leader isn't immune.
Not at all. It shows that everyone is feeling these cyclical demand pressures. And just ahead of VW was Geely Auto, delivering about 1.07 million BEVs.
So VW is firmly among the heavyweights, but there's clear pressure from Tesla despite the dip, and obviously from the surging Chinese giants like BYD and Geely. The need to accelerate and cut costs is urgent.
Absolutely. And that urgency brings us directly to their strategic solution, this massive investment in battery independence. And it's a two-pronged approach, aimed squarely at solving that cost and supply equation.
Let's talk about that duality, because on one hand, you have the in-house immediate future plan with PowerCo, and on the other, this revolutionary moonshot with QuantumScape.
Exactly. I mean, VW realized they just cannot rely on external suppliers, or mostly from Asia, to get the scale and cost reduction they need. They're seeking true technological independence through PowerCo, which is their own internal battery company.
And the big news here is that the first in-house battery cells actually rolled off the production line at the Salzgitter site in Germany. This isn't just R&D anymore, this is real production.
It's a critical milestone. It validates their whole concept of the unified cell.
Mm-hmm.
And this is the cornerstone of the whole strategy. It's a standardized battery cell that's designed to be used across pretty much all VW Group brands, models, and markets. For a company with their complexity, that standardization is huge.
From a Okoda to an Audi?
Exactly. It drastically simplifies manufacturing and lets them hit these extreme economies of scale. And that's what drives down the final cost of the car.
Standardization is key, but what about the actual tech in this unified cell? What are they starting with?
Initially, they're using NMC chemistry, that's nickel manganese cobalt. It offers about 10% higher energy density than their current cells, so more range for the same physical space. But importantly, PowerCo is also planning a lower cost alternative, LFP versions, lithium iron phosphate.
We've heard so much about LFP batteries lately. For the listener, why is LFP so critical for VW's mass market strategy, even if it offers less energy density?
Because LFP is the key to affordability and safety. It uses materials that are cheaper, more readily available, and it cuts the cost per kilowatt hour substantially. So while it gives you less range making, maybe not ideal for a premium long-distance car, it is perfect for those crucial entry-level, city-focused electric cars. That LFP unified cell is what makes a car like the ID Polo at 25,000 euros even possible.
And the scale they're planning is just immense. Salzgitter is targeting 20 GW annually, and that's expandable to 40. But that's just the start.
Oh yeah, it's the blueprint.
Yeah.
Salzgitter is the template for their upcoming factories in Valencia and in Canada. The ambition is to eventually cover about half of the group's total battery demand internally.
So that's PowerCo, the scalable near-term solution. Now let's pivot to the long-term, high-risk, high-reward bet. Solid-state batteries with QuantumScape. This is where the real technological leap is supposed to happen.
This is the strategic moonshot. In July 2025, PowerCo significantly expanded its collaboration with QuantumScape to accelerate their QSE-5 battery pilot line in San Jose.
QuantumScape's technology, it's designed to revolutionize energy storage. Can you just quickly explain the promise of solid-state? Why is it considered the holy grail?
Well, current lithium-ion batteries use a liquid or gel electrolyte, right? And that poses some stability and safety issues, and it limits how fast you can charge. Solid state replaces that liquid with a solid ceramic separator, and in QuantumScape's case, they use a pure lithium metal anode. The promise is threefold. Much greater energy density, so longer range, significantly faster charging, we're talking maybe 80% in minutes, and just inherently better safety. If it works at scale, it's a complete game changer.
It sounds revolutionary, but also incredibly difficult to commercialize. How is VW backing this up financially?
With immense confidence. PowerCo is providing up to $131 million in new payments over 2 years, all based on hitting very specific technical milestones. And that's on top of the $130 million they'd already committed. So they're investing well over $250 million in this one technology.
That level of commitment, it just underscores their dedication. And the licensing agreement is also telling. It gives PowerCo the right to produce an additional 5 GW of these cells, including for customers outside the Volkswagen Group.
Yes. They aren't just securing tech for their own cars. They're securing the right to become a battery producer for the whole industry, assuming it all works. This duality, the high-volume unified cell now, and the future-proof solid-state IP, that is, VW's definitive strategy.
Okay, now we have to transition because this massive investment came at a devastating cost in 2025. This brings us right back to that financial reality.
The contraction was severe. The group's operating result dropped by 57.8%. It fell from 12.8 billion euros in the first 9 months of 2024 to just 5.4 billion for the same period in 2025.
So the operating margin plummeted.
It did? From 5.4% all the way down to just 2.3%.
That is a staggering loss of efficiency. We need to be clear with the listener about what caused this. It wasn't just the cost of ramping up new EV lines, was it?
No, not at all. It was dominated by specific heavy charges. We're talking about additional provisions and impairments that totaled around 4.7 billion euros. And these were mostly for two things: a realignment of Porsche's product strategy and a significant goodwill impairment.
Let's break those down. First, what does realignment of Porsche's product strategy actually mean in plain English?
It generally means they had to scrap or significantly delay previously planned R&D or factory spending for new models, likely premium EVs, because the market changed or the tech wasn't ready. When you scrap those plans, you have to write down the assets. It's a huge financial hit, and it signals a major course correction at their highest margin brand.
And the second one, goodwill impairment. That's a financial concept. Why would VW need to write down goodwill?
Goodwill is basically the intangible value of a brand or business unit. Its reputation, its future earning potential. If a company decides a business unit's future cash flows are going to be lower than they thought, they have to write down that goodwill. The fact that VW took a major impairment suggests they are becoming much more cautious, even pessimistic, about the short-term profitability of certain parts of the business.
And beyond those internal costs, the sources cited geopolitical problems, the tariff issue.
Yes, U.S. tariffs were cited as a massive burden, potentially adding up to 5 billion euros on a full-year basis. That is not a rounding error. That's a strategic annual anchor on their profitability.
And you can see the pain when you look at the brand mix. The core brands managed a stable margin. Koda did really well at 8%. But the sport luxury group, Porsche, saw an 11% drop in deliveries and posted a negative operating result.
The core of the problem is right there. Porsche is their cash cow. When the transition hits your highest margin segment that hard, the group results just crater. The CFO, Arno Antlitz, was very clear. He said the ramp-up of lower-margin EVs combined with those massive, painful charges were the primary drivers.
So 2025 was the year of financial pain. The payoff, they hope, comes in 2026 and beyond, with a focus on affordability and volume powered by those new in-house cells.
That is the crucial link. The unified cell is designed specifically to enable that next phase: mass market affordability. The focus is shifting completely to compact, affordable electric cars to drive volume way beyond that current 10.9% share.
And we're talking about models that could define the European market, like the ID Polo. What makes this new fleet so important?
It's the price point combined with the tech. The ID Polo is expected to start around 25,000 euros, but still offer a competitive 450 kilometers of range, 226 horsepower. Then you have the Cooper Ravel, the Skoda Epic. This affordable segment is critical for broad consumer adoption. It's where the lower production cost from PowerCo meets the quality and range people actually expect.
And while they're pushing affordability, they're not sacrificing their engineering reputation, which is so important long term.
Exactly. The TÜV report for 2026 had an interesting validation point on this. It confirmed the high reliability of VW EVs. Models like the Audi Q4 e-tron showed a defect rate of only 4% after 42,000 kilometers. VW is betting that their quality, combined with cost control, will let them win in that crowded European market.
So to sum up, we have a company that hit a major volume milestone, nearly 1 million EVs, while enduring a devastating financial hit. All due to massive investment in this dual-path battery strategy and those external geopolitical headwinds. The equation they have to solve now is turning that expensive volume into profitable scale. And fast.
That is the core calculus. The pain of 2025 was the cost of securing independence and scale. The question now is whether the technological lead they get from the unified cell and the potential profit from that ID, Polo family, can outrun the ongoing financial drag from tariffs and the competition in China.
Which brings us to our final thought for you, the listener, to mull over. VW is aggressively moving to vertical integration, taking control of its own battery supply chain to reduce its dependence and maximize scale. So, given that the ID Polo is set to launch at a competitive €25,000 price point in 2026, and their BEV order book in Europe is surging, suggesting the demand is there, Is the financial weakness we saw in 2025 merely a painful but necessary investment toward long-term supremacy? Or does the ongoing threat of high U.S. tariffs and the dominance of Chinese rivals still outweigh the potential benefits of their new unified cell strategy?
I think the answer to that will lie in the profitability margin of that 25,000 euro ID Polo. That single vehicle will be the litmus test for whether this entire incredibly expensive pivot has truly paid off.